Hey, welcome to my channel guys. I hope you are doing well, and in today's video we will be covering about management of foreign exchange exposures. In this we will be covering about the types of exposure, and among these exposure is the transaction exposure. We'll be learning about the management of the transaction exposure in detail in today's lecture, right? So stay tuned. So let's begin with we can see that whenever the business expand, it goes into the international market, right? So whenever the business goes into international market, the very first risk that it encounters is the fluctuating exchange rate, right? What are the exchange rate? Say in Indian currency, in Indian rupee to US dollars, it keeps on fluctuating every day. So this is the exchange rate that keeps on fluctuating. So this exchange rate affects the settlement of the contract, the cash flows, that means inflows and outflow of the cash to your country and to your firm as well, and the firm's valuation, right? We'll understand this within an example also. Let's see about the example. Say an Indian company that purchased from US a machinery worth rupees 10,000 US dollar. It went into a contract in the month of June, and in the month of June the exchange rate was rupees 76 per US dollars, right? However, the terms of payment was due in the month of September, where the exchange rate, that is Indian rupee to US dollar, went to rupees 85 per US dollar. So you can see that when the Indian company contracted, that on that day the exchange rate was 76 rupees per US dollar. However, when the payment was made, it went to 85 rupees per US dollar. So this fluctuation is known as the fluctuation or the risk of foreign exchange. So whenever the company goes international, it faces the fluctuating foreign exchange. This is why we need to manage it. We need to mitigate such risk and such exposures, right? So here are the types of exposure. We have basically three types of exposure. First is the transaction, then economic and translation exposure. Let's understand this one by one. First is the transaction exposure. Now what is transaction exposure? Simply I say the transaction means to buy or sell something, right? Whenever I buy or sell, say, any goods or services, I go into transaction. So whenever I go into transaction, that is international transaction, so there is a risk of unexpected exchange rate changes. Simple, right? Next is your economic exposure. Over here, the extent is the whole value of the firm is being affected by unanticipated change in the foreign exchange. Understood? First was only for your transaction, one transaction. Okay, economic is for the entire firm, and last is the translation exposure. Translation exposure is done for the consolidated financial statement that are being affected by the change in the exchange rates. Now, see, supposedly there is a firm, there is a headquarter that is US. It is a holding company over here is in US. It is operating in various countries. I am taking over here in an example. Say it is operating in India. Okay. It is operating in Africa and one more country, say in UK. Okay. So, sorry, over here it is UK. So, headquarter is in US. It has many of its subsidiaries, say in India, Africa, UK, so on and so forth. Over here, the Indian firm will be operating in Indian currency. African firm, the subsidiary will be operating in African currency, and the UK company will be operating in UK currency. So, when the financial statements are being compiled, say in the Indian firm, it will be in Indian currency. In the Africa, when the financial statements are being completed, it will be in African currency, and similarly for the UK. So when all the subsidiaries combine the financial statement with the headquarter that is in US, this has to be translated. These domestic currencies need to be translated to the US dollar, that is the holding company. So this changes or this fluctuation in the currencies of subsidiary and the holding is known as the translation exposure. I hope you guys have understood, and in case of any queries, please comment in the comment section. I will surely reply to you guys. So in today's lecture, we will be dealing with the transaction exposure in detail. As I have already explained to you that there is a fluctuation in the exchange rate, right? That is the cross country contract. Okay, and we fix the specific amount of money and quantity in advance. This is also known as the short term economic exposure. Now there is also one thing that you need to note over here is larger is the time gap between agreement and the settlement, larger will be the risk involved in the exchange rate fluctuation. How? Supposedly there is a gap between, say, agreement was made in the month of April, right? And the transaction or the settlement is being done in the month of June, right? So how many months are there between these agreement and the settlement? April, May and June. That means 3 months were there. However, if I say the agreement was made in the month of April, but it was settled in the month of December. So how many months over here? Over here 9 months are there. So where will be the risk more? In the second one, because the time frame is more. When the time keeps on increasing, there is a risk involved. The risk involved in the exchange rate keeps on increasing, right? So let's understand about the various hedging transaction exposure. What is the meaning of hedging? That means to mitigate or to protect or to minimize the transaction exposures. So these can be done through two methods. First is the financial contracts. Contracts can be the forward, money market, options or the swaps. Whereas various techniques can also be used. First is the currency risk sharing, then is the lead and lag strategy, and last one is the exposure netting. So let's study this one by one. First is the forward market hedge. Now what are forward market hedges? Today I am sitting over here and I contract with any of the US firms, right? The agreement is held on, what is the date today? Say 22nd of September, I went into an agreement that I will buy a machinery of say rupees 10,000 from you, but the payment I will make after 2 months. That means in November I will be making a payment. So what do? I fix this rupees. I say I will pay you 10,000 only, but after 2 months this 10,000 might increase or decrease in future. After say 2 months it will fluctuate. The currencies, the foreign currencies keeps on fluctuating, so this 10,000 might increase or decrease. So today if I fix at 10,000, I will pay only 10,000 in the month of November, no matter if this 10,000 goes up to say 12,000 or 13,000 or whatever. However, if supposedly it goes to 9,000, then still I will have to pay 10,000 only, because I have went into an agreement that I will pay 10,000 as a buyer. Next is the money market hedge. Now how this works is that I've taken an example. Say US firm is operating and it purchased something from say UK in British pound. It purchases something in British pound. So what it does is it borrows in US dollars. It borrows certain loan and converts this into the pounds, and then it invests that money that it has been converted into pounds into the British treasury bill. That is a money market instrument. Any of the money market instrument it can go and invest, and then the final whatever is a gain or loss out of that, the bill will be paid by the firm, right? So what the firm does, it firstly takes the loan in the home currency, okay, then it converts it into the other country's currency, and then finally it invests in the money market instruments, and whatever is the gain or loss, the resultant is being used to make the payment to the country, right, the exporters. Next is the option market hedge. Now, what is the option market hedge? It is simply a contract where the buyer has the right but not the obligation, right? Buyer has the right but not the obligation to buy or sell a certain currency at a certain specified exchange rate on or before a specified date. Guys, I have already discussed with you about the forward market, right? Over that, I told you that I have fixed certain rupees, say 10,000. I fixed that amount. I, as a buyer, had to make a payment of 10,000. Whether there was increase or decrease, there was an obligation. However, in option market, you do not have any obligation, rather, you have the right. So the example, let's continue the example. So over here, that if I fix that 10,000 and say after 2 months it decreases to 9,000, I might not be interested to buy. Why should I give 10,000 instead of 9,000? I will not exercise this, right? However, if this price goes up to say 12,000, then I will exercise and buy at the rate 10,000. That was fixed in the contract. This is known as the option. The difference between the forward and the option market is that there is no obligation in the option market, first. Second is that I can buy on or before any specified date, right? In the forward there was a specific date. However, in the option market, you can buy any time before the specific date or on the specific date itself, right? Okay, next is the swap. Now, what is this meaning of swap? Simply exchange, right? You have something, I have something, we swap it, right? It should benefit both of us. I've taken one of the examples over here. I'll explain this to you with the help of an example. Over here we have two firms. One is US and one is the African firm. Now, US firm has an option. It can easily get US loan in US dollars. It can get a US loan at the rate of 6%. However, it wants to invest in Africa, but in the African currency, that is in rand, the loan is available at the rate of 9%, right? Another firm, that is African firm, that can borrow in US dollar at the rate of 8%. However, it has also an option of that is available at the rate of 11% in US dollar. So what they do is that they exchange their rate of interest. They'll have the principal and they will they will swap the interest rate, so that both of the firms benefits from such a transaction, right? So let's understand the meaning. The transaction between two parties, we've understood. Exchange an equivalent amount of money with each other but in different currencies first, and these are primarily used for the potential risk associated with fluctuations in currency exchange rates or to obtain lower interest rates on the loans in the foreign currencies, right? I hope you've understood the meaning of swap markets. Now we are going to start about the various techniques of hedging. First is the currency risk sharing. Over here, what do we do? If supposedly there are two firms, A and B firms are there, they will fix a certain currencies exchange rate. They will set a certain currency in advance. Say we say to rupees 70 per US dollars, it has already been set. So this is the currency risk sharing between A and B, say two firms, right, operating internationally. Next is the leading and lagging. What do you understand by the term leading? That means in advance, taking forward steps, and lagging is to go back. So we take into consideration whatever is going to happen in future. Supposedly when there was a Russian-Ukraine war, what people were expecting over there? That oil prices might rise. So that is leading. That means I am taking assumptions, or I am predicting that might happen in future, right? However, for lagging, I take into consideration my past experience from various wars that happened. We make certain assumptions and we predicted, and we went for the forecast that this might happen in future, right? So this is your leading and lagging. Last but not the least, your last technique is your exposure netting. So over here, what do? There are number of transactions for imports and exports, right? So netting is being done. That means total is being done. So if the importer keeps on gaining every time the importer keeps on getting say positive return, it will be offset by his loss in exports and vice versa. So this is your total netting. That means your profits or the losses from imports that is being equalized from your profits or losses from your exports. That is it for today, guys. I hope you have liked and learned something. If yes, then please do like, share and subscribe to my channel. Thank you and have a nice day.